Millions of Americans might be heading for a retirement disaster. Here's why. Have you ever wondered if your retirement plan is truly secure? In this video, we'll expose the dangerous myths that could jeopardize your future, like the 4% rule, target date funds, and even advice from financial advisors. These common strategies may not be as reliable as you think, and understanding their flaws is critical to protecting your financial future. Stay tuned as we reveal smarter alternatives designed to help you navigate these pitfalls and build a retirement plan you can count on. Your future deserves nothing less. The 4% rule has been a cornerstone of retirement planning for decades, but does it really hold up in today's world? This rule could leave retirees facing financial shortfalls or living too cautiously, sacrificing their quality of life. To understand its limitations, let's revisit its origins and explore why it no longer fits the modern economic landscape. In the 1990s, financial planner William Bengen developed the 4% rule by analyzing historical market data. He found that retirees could withdraw 4% of their portfolio in the first year of retirement, adjusting for inflation annually, and still have their savings last for 30 years. At the time, this was groundbreaking advice rooted in a balanced portfolio of 50% stocks and 50% bonds, steady market growth, and low fees. But while Bengen's model worked then, the world has changed in ways his assumptions couldn't predict. Today's retirees face a very different reality. People are living longer, well into their 90s and beyond, making the 30-year horizon feel outdated. Healthcare costs are rising, markets are more volatile, and fees for financial products and advisors have increased. On top of that, the rigid withdrawal rate of 4% doesn't account for the ups and downs of real-world investing. Imagine retiring just before a market crash like in 2008, when portfolios lost 30 to 40% of their value. Withdrawing the same amount in such a scenario could deplete your savings far faster than planned. Picture this: you've saved $1 million for retirement. Under the 4% rule, you'd withdraw $40,000 in your first year. But if a market downturn slashes your portfolio to $600,000, that $40,000 withdrawal becomes a much larger percentage of your remaining savings. Without adjustments, you could run out of money long before you expect. This highlights a critical flaw. The rule assumes stability in a world that's anything but stable. Research by firms like Schwab and Morningstar has revealed two common pitfalls of rigidly following the 4% rule. On one hand, you might overspend and risk depleting your portfolio too quickly, especially if markets underperform or unexpected expenses arise. On the other hand, sticking too cautiously to the rule could leave you with a large balance you never use, limiting your lifestyle unnecessarily. This raises an important question. So, what's a more reliable approach to ensure your retirement savings last? Experts increasingly recommend flexible withdrawal strategies tailored to individual circumstances. For example, Schwab suggests adjusting your withdrawals based on market performance and personal needs. In a bad market year, you might withdraw less to give your investments time to recover. In a strong year, you could take out a bit more. This dynamic approach helps protect your savings while allowing for a better quality of life. Another issue with the 4% rule is its failure to account for fees. Even with low-cost index funds, many investors still pay for fund management, advisor guidance, and platform costs, which chip away at returns over time. Morningstar has proposed a lower inflation-adjusted withdrawal rate of 3.7% as a safer benchmark for today's retirees. While 0.3% might not sound like much, over a 30 or 40-year retirement, it could mean the difference between running out of money and having your savings last an extra decade. Think of the 4% rule like a one-size-fits-all diet plan. It might work for some, but it doesn't consider individual health needs, or in this case, your unique financial situation. A more personalized approach, like diversifying your portfolio or using a bucket strategy to manage short-term and long-term needs, can provide greater flexibility and security. The bottom line, the 4% rule served its purpose in the 1990s, but today's economic complexities demand more adaptable strategies. Lowering the withdrawal rate to 3.7% is a good starting point, but the key is tailoring your plan to fit your life. And speaking of outdated strategies, next we'll uncover the hidden risks of target date funds. You won't want to miss it. Think target date funds are the ultimate set-it-and-forget-it solution to retirement? They're marketed that way, but the truth is more complicated. Over $2.8 trillion is invested in these funds, making them a popular choice in many 401k plans. They promise simplicity by automatically adjusting your investments over time. You pick a target year, usually your retirement year, and the fund gradually shifts your money from stocks to bonds, aiming to reduce risk as you approach retirement. Sounds ideal, right? Unfortunately, there are serious flaws in how these funds operate that could cost you thousands of dollars. Let's start with performance. Target date funds have consistently underperformed compared to other investment options. For instance, over a 28-year period, funds targeting retirement in 2040 returned just 750%. While that might seem decent at first glance, the S&P 500 delivered a staggering 1,494% during the same period. Even a balanced portfolio of 60% stocks and 40% bonds earned 866%, significantly higher. Why such a gap? Poor management and flawed asset allocation are major factors. Many target date funds lean heavily on international equities, which have underperformed U.S. stocks for nearly 15 years. This reliance drags down returns, leaving investors with less growth than they could achieve elsewhere. Not only do they underperform, but target date funds also present significant risks. One of their main selling points is the promise of reduced risk as retirement nears. However, during volatile markets, this safety net often fails. In 2008, many 2010 target date funds, meant for those retiring in just 2 years, lost between 30% and 40% of their value. Imagine being on the brink of retirement and seeing nearly half your savings wiped out. Even more recently, in the 2022 bear market, 2020 funds, designed for retirees, lost over 11%. These funds are supposed to protect investors during downturns, yet they often fall short when it matters most. A key issue lies in their approach to bonds. As retirement nears, target date funds shift more money into bonds, assuming they're a safer investment. But this strategy doesn't always hold up. In unpredictable markets, bonds can underperform, dragging down returns instead of preserving them. If too much is moved into bonds too quickly, it limits growth potential at a time when many retirees still need it. Fees are another hidden danger. While expense ratios for target date funds have dropped in recent years, from an average of 0.66% in 2017 to 0.32% in 2022, fees still add up over time. Imagine paying $32 annually for every $10,000 invested. Over 30 years, that's nearly $1,000 eaten away by fees, and that's assuming your fund has average costs. If you're in a higher cost fund, the impact is even worse. These funds are marketed as cost-effective, but many investors could save money and earn better returns by managing their portfolios or choosing low-cost index funds. Another major flaw is their one-size-fits-all approach. Target date funds assume everyone with the same retirement timeline should invest the same way, ignoring individual circumstances. Think of it like a one-size-fits-all suit. It might fit some people, but it won't suit everyone. Maybe you're nearing retirement but still working part-time, or perhaps you have unique financial challenges like medical expenses. A cookie-cutter strategy doesn't account for these nuances. As one financial expert explains, target date funds don't solve all problems for all people all of the time. Personalizing your investment strategy, whether by consulting a financial planner or taking a more active role, can lead to better outcomes. So what can you do instead? Start by reviewing your fund's prospectus. Look for hidden fees and assess where your money is being invested. Are they overly reliant on bonds or underperforming international equities? Next, consider whether you even need a target date fund. A mix of low-cost index funds and ETFs can offer more transparency and flexibility. Alternatively, choosing a fund with a later target date can keep you invested in stocks longer, potentially boosting growth while you're younger. Ultimately, while target date funds are designed to simplify investing, simplicity doesn't always mean better results. Their underperformance, hidden costs, and generic approach make them a risky choice for long-term retirement success. If you want stronger growth and more control over your financial future, exploring alternative strategies is worth the effort. Retirement planning isn't a one-size-fits-all formula. Blindly following outdated advice like the 4% rule or relying on target date funds can lead to financial disaster. The Schwab Center for Financial Research highlights that rigidly sticking to these guidelines often ignores your unique needs and circumstances. Instead, explore flexible strategies, diversify your portfolio, and seek smarter, low-fee investment options. Don't let outdated rules jeopardize your retirement. Take control today. Question everything, because your financial future depends on it. Remember, your retirement is yours to shape, don't leave it to chance. Start making informed decisions now for the future you deserve. Remember, this is for educational purposes only and not financial advice. Consult a qualified professional for investment advice. If you found this video helpful, please like, subscribe, and hit that notification bell. Your support helps us create more valuable content for you.